Hi, this is Mike Larson for Money and Markets TV. The Dow has rallied more than 1,200 points just since October 4th, a gain of around 12%. Folks, that's the type of return investors are likely to get over an entire year, much less a week. And judging from those numbers, you might think we're in a strong economy and market environment. You might even ask whether this is the start of a new bull market, and whether you should jump on board before it's too late. My answer? Heck no. The bulls are making the case that the situation is similar to the one we faced in March of 2009. At that time, the U.S. conducted stress tests for the banking industry and launched a bank recapitalization plan, and the market took off like a rocket. The Dow rose from below 6,500 all the way to nearly 13,000. Now, since Europe is making noises about its own recapitalization plan, the bulls are just assuming the results will be the same. But I'm looking at the current environment and asking, what the heck are these guys thinking? This ain't March 2009. First, the markets back then had already been falling like a rock for several quarters. The Dow had already plunged 7,700 points in about 18 months through March of 2009. Second, the economy had also already seen several months of dramatic recessionary shrinkage. Industrial production, retail sales, home construction, and more had fallen substantially from their peaks. Third, the Federal Reserve was in the midst of a massive money printing scheme, what we know or now call QE1. And fourth, the $800+ billion economic stimulus package from the Obama administration was signed into law around that time. This combination provided a huge amount of extremely dry tinder. All that was needed for a major rally was a spark, and the stress test and recapitalization plan was it. But this time around, we've only lost about 1,500 Dow points from the peak, less than 1/5 of the decline from 2007 to 2009. This time around, we're only just entering a second recessionary period, rather than reaching the end of one. This time around, there's no QE3 plan out there to support the markets. I mean, the Fed could barely get the weak Operation Twist plan past the deeply divided policy committee, making another round of money printing an impossibility. And most importantly, this time around, governments are tapped out. They don't have the money to infuse hundreds of billions of dollars into the global banking system to prop it up, much less provide another $1 trillion of fiscal stimulus. Just witness the defeat of President Obama's $447 billion jobs plan in the Senate this week, or the recent multiple-notch downgrades of the credit ratings of Italy and Spain. Bottom line, neither the fundamentals nor the technicals support the case for a massive bull run. So my recommendation couldn't be more clear. Don't chase this rally. Anyone who does is going to regret it. I'm Mike Larson for Money and Markets TV. Thanks for watching.